Money Radio for a really great future. We're talking real money.
Well, all I can say is that it's a darn good thing that last week it was a Tom and Roxy Q&A with written questions, because the called-in questions are getting a little sparse. I'm doing 5 today, but as of when I recorded this, that only leaves me with 4. So I'm going to need at least another 1, preferably more, to keep up the same pace so I don't shortchange you on a Friday. Because I got to have your questions to do the Friday Q&A. Otherwise, it's just a bunch of A. No Q. What fun is that? Hi, everybody. I'm Don McDonald. Welcome to the Friday Q&A edition of the Talking Real Money podcast. So glad you could listen in today, or whenever you're listening. Well, when you're listening, it is today. It's for you. It's today. And as I said, we've got 5 questions that came in through the TalkingRealMoney.com website on the Contact Us form that were spoken through your electronic device's microphone. Your phones, your computers, whatever it might be. You spoke it. Like I'm doing right now. I am speaking into a mic into my computer. That's what it is. That's how we do this. So much easier than the old days when we spoke through a mic onto tape. And then, anyway, it was a nightmare. So I've got a bunch of questions for you today, and I hope you send in some more soon at TalkingRealMoney.com. Let's get to the first one, shall we?
Hello, Don. This is Mark from Puyallup, Washington. My question is in regards to the Backdoor Roth conversion. We'd like to do that this year, but I'm a little bit confused, and I'm looking for your input. My understanding was you typically wanted to take the money, the contributions, stick it into a traditional IRA with a zero balance, and then immediately move it into the Roth. And the scenario that we have is my wife's with Vanguard only had a Roth IRA, and our adjusted gross income we now know is above the limit. So we contacted Vanguard to do a backdoor Roth conversion, but first we had to open up a traditional IRA and recharacterize 2025's contributions of $8,000 because we're over 50, recharacterize that and move that into that newly opened traditional IRA. So we went ahead and did that, but there was gains on those contributions during the year. So there was a new balance of in that traditional when those funds were moved to like $9,500 and change. So my question is can we still do the backdoor Roth conversion of the $8,000 now that that traditional is open, or being that there's those gains, does that now complicate things? Because if I moved the $8,000 to do the Roth conversion, that's going to leave $1,500 and change in that newly opened traditional IRA. So my question is can you still do that, or is it best now going forward to, if we know in the year we're going to be under the limit, to contribute to the Roths, and if we know we're going to be over the limit, to then just don't contribute to the Roths and contribute to the traditional?
Okay, well, that part's right. Yeah, if you know you're going to be under the limit, just contribute to the Roth. But in this case, it's really easy. And again, I'm assuming you have no other traditional IRAs. If you do, it complicates things. But as it stands right now, just move the whole $9,500 from the traditional IRA you have created, the non-deductible IRA, move all of that into the Roth, and you'll pay taxes on $1,500. That's all. That's it. No penalties, no hassles, no headaches. You'll pay taxes on the $1,500. Hey, it's a bonus. That was a really good year, by the way, for that fund. Whatever you put it in did really well. But no, just do the conversion to the Roth, do the backdoor Roth with all of it, pay the taxes on the $1,500. It should be a relatively simple process. Thanks so much for the question, and please Ask them at talkingrealmoney.com on the contact form. You can speak them in, which I prefer, or yes, you can type them. But this one, as you'll see, is, well, it was spoken.
Hi, Don. Question for you. In equity funds, besides factor tilts, another reason you favor Avantis and DFA is their flexible trading approach. For example, not reconstituting the index on the specific day or getting the last trading price of the day to match the index. On the other hand, for fixed income, factor tilts are not an issue, but is trading flexibility? And would that be a reason to consider those fund families for fixed income instead of BND or VTEB? Thank you very much, and regards to Tom and Roxy.
Well, bond funds are different. Trading is not as important in a bond fund. Avoiding new offerings is not a big deal with a bond fund. They're a very different beast. The biggest difference between a bond ETF of Avantis and a bond ETF of Vanguard really is going to come down to, well, a couple of things. One is going to be fees. The fees are going to be much lower, and fees matter more with fixed income portfolios. They are a huge drag. Even though they're not big fees, I think Avantis has a bond fund that's about 0.15, but BND is 0.03. So it's a lot different. And when you're talking about fractional differences and, fractions of a percent differences, that kind of fee makes a difference. When you look at an Avantis or a DFW bond fund compared with Vanguard's bond ETFs, I really would lean more toward the straightforward Vanguard. You're going to get a bigger portfolio. You're going to get better buying power because these portfolios are big, and the more bonds you buy, the better your bid-ask spread is going to be. You're going to get a much better price, and you can see it in the yields. The Avantis fixed income fund is a little bit more aggressive and has almost exactly the same yield as BND. They're just tiny fractions of a percent difference. So I would go with the bigger, better, broader bond funds when it comes to bonds. I think there's an advantage to Avantis's and Dimensional's approach when it comes to equities. I don't think there's an advantage, or at least much of an advantage, or the likelihood of a big advantage when it comes to fixed income. Thanks for the question. Now for the next one.
Hi, this is Joseph in Nashville, Tennessee. I have two children, ages 14 and 11. My children have a generous grandfather who is giving them each $5,000. My gut feeling on the best thing to do with that money is to open a 529 account for each of them. I've been looking at the Utah 529 plan, as I've heard it's a very good plan. I don't know if one or both of my children will attend college, but I know they would now have the ability to roll the funds over from a 529 to a Roth IRA if they don't need the money for college. My question is, do you feel like a 529 account for each of them is the best way to go with this money? And if not, what would you recommend? And then also, is it better for a parent or grandparent to be the owner of the account if you want to avoid the 529 impacting their eligibility for financial aid when they apply through FAFSA in the future? Anyways, I love your show. Thanks in advance for your help.
Well, the 529 plans had me at tax-free growth for college, but add in the Roth conversion capability for kids who don't go to school, and these are like the perfect vehicle. So yeah, it's the right thing to do, and Utah's is a very good plan. As for ownership, couple of different schools of thought. If the grandparents own it, yeah, when it comes to federal aid, the income, the asset, the 529 asset does not need to be reported on the FAFSA. It's not yours or the kids. So that's an advantage they've now kind of straightened out. That is an advantage to grandparents. But the other advantage to parent ownership is flexibility. Now, technically, the grandparents are giving the money to you, but that can fall under the gift tax exclusion, so there's no big deal there. And you then have control rather than having to go through another party to, as long as your relationship is good, that's not a big deal. But if the relationship soured, the grandparents didn't want to give it to them for a trade school or whatever, then they would make that call. And they also have control. They can change the beneficiary of those. So if you want more parental control than the parents, but it does count on the FAFSA. So there you have the choices that you have to make. Thank you very much for listening and for the question, and it's time for another one.
Hi, this is James from Virginia. I had a question, something I've been noticing when buying either Avantis or dimensional funds, or I should say ETFs on Vanguard's platform. So I have a UGMA for my 2 and 4-year-old that I put in $10 a week. And then as soon as it gets enough to buy either DFAW or AVGE, I make the purchase. But I've noticed when it's such small amounts, so it's like one share typically, the quote will be, let's say $86. And then when I go to place the trade, it'll be like 110. It'll always be like $20 or $30 more if I put it in as a market order. I was wondering if you could shed some light on why that would be. Sometimes I've switched it to a limit order and set it to the price that the real-time quote originally says, and eventually it'll process throughout the day. But if I try to do a market order for just like one share, it ends up being, $15, $20, sometimes $30 more, which is a pretty big difference. Thanks.
This makes absolutely no sense. None whatsoever. I have never heard of this. I cannot imagine a scenario in which this would happen. There is no logical reason that I can come up with. There is no huge odd lot premium with ETFs. There is no wide spread with the funds you're talking about. DFAW, I just looked it up. The spread is 6 cents. So even if you saw the bid price and paid the ask price, you'd be paying 6 cents more. And the whole limit thing confuses the picture even more. So are you sure you're seeing a price from the confirmation that you get, not from, the order's going to be placed? Maybe they're just giving you an overly, ridiculously conservative estimate. I don't know, but something's wrong. This is not right. And I've never, ever, ever heard of this nor seen this occur. In my own accounts or in any of my listeners' accounts, this is too odd. If you could, send me an image, a screenshot of your confirmation on a trade and the date you did it, and I can go back and look at what the bid-ask spread was on that date. The other thing I would suggest is picking up the phone and calling Vanguard and saying, is this right? I mean, I guess maybe they're making mistakes, but it just doesn't sound like them. I don't know. I am baffled. This makes no sense whatsoever. Hope for a follow-up. And now let's go to our last question of the day that was sent in at talkingrealmoney.com on the contact form.
Hi, Tom and Don. In a recent podcast, you estimated the number of stocks or equities within AVGE, and I think you said it might be as low as 7,000. I believe that VT has 12 or 13,000 equities. I like the idea of having a globally diversified portfolio that tilts towards small in value, but it makes me nervous to have only 7,000 stocks in AVGE. I've thought about using VT for the majority of my portfolio and then adding some Avantis small in value ETFs. That becomes much more complicated with US and international, and I'd rather just have one fund for the equity portion of my portfolio. Can you comment on my concern of having relatively few stocks in AVGE? Maybe you can help me feel more comfortable with staying there. I know that they use factors, et cetera. It's just, when you talk about diversity, it's all about the number of equities, and AVGE seems pretty small relatively. I could understand if AVGE purchased the same number of equities as VT, but purchased more shares of small in value and fewer shares of large and growth. But why does AVGE exclude so many equities, and how can I feel confident that they are excluding the right ones? I looked at the performance history of the two funds. If I'm looking at this correctly, VT has outperformed AVGE over the last 3 years. I know that 3 years is nothing when talking about fund performance, but I'm having a hard time staying in AVGE rather than moving to VT. I look forward to hearing your thoughts.
Well, this is kind of like comparing apples and dragon fruit or something. You know, they're fruit, but they're different. I think the 7,000 figure is really low. I don't think it can be that low. The number I kind of roughly came up with just looking through the funds is in the 9,000 area, although I did see one reference online to 10,600 stocks. So that means the two are not far apart at all. Looking at VT right now in January of 2026, according to Morningstar, VT has about 10,000. Oh, I'm sorry. I take that back. Less than 9,900 equity holdings in their portfolio. So that means that the two are probably not that different. I think 7,000 is not a good number. I don't think that's a good number. I'd be willing to bet it's closer to 9, which makes sense because they're going to exclude new issues. They are not going to blindly follow the indexes. So the fact that there's some difference doesn't surprise me. And bear in mind that VT owns the whole universe. They own them all. So Avantis is not going to be adding small cap. They're just going to be overweighting small cap, the same small cap that Vanguard owns. Vanguard owns all of them. Vanguard's portfolio includes everything that's in AVGE's portfolio. It's just that AVGE cuts a few out that don't meet their criteria, and theirs is a rules-based criteria. It is not seat-of-the-pants squiggly line stuff. It's based on profitability. It's based on momentum. It's based on value. It's based on small. So they have a lot of screens, a lot of rules through which stocks must go, and some of them, not many, but some get kicked out along the way. And longer term, that should be good for you, but be careful comparing performance because VT has the advantage of having been much more heavily invested in the Magnificent Seven. And as we've said over and over again, the Magnificent Seven account for a giant percentage of the S&P 500, which is the bulk of the stock market's total returns over the past few years. AVGE is not getting that same benefit. AVGE is going to do better in an environment when small and value is the preferred investment, as it has been more than growth having been the preferred investment. So different funds. We still believe the research makes sense. And we also believe in the Avantis and DFA style because they're taking more risk to potentially provide investors with a higher return. That's what risk is all about. Generally, you get higher returns when you take more risk. Overweighting value, overweighting small, for example, those are both riskier categories in general. That's why we believe that the research has shown these differences. Thanks so much for the question, though. It's a good one. And thank you all for your questions. If you have some, go to talkingrealmoney.com, click on the contact button, and then record them or type them in. And thanks so much for listening. Tell a friend or two. And we're here almost every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.